Hello, everyone. Jason Gordon with today's mortgage market update. It is March 4th, 2022. For compliance purposes, I work for AmeriFirst Financial. My NMLS ID is 259027. And for more information about me and my company, please visit VIPborrower.com. So, quick lesson for you. As many of you do know, when a borrower gets a new mortgage, there are two different ways that they pay. Way number one is the upfront cost. We call those non-recurring closing costs. And if I ask the client just by itself, do you want to pay high cost or low cost? I think we all know the answer. Of course, they want to pay low cost. But category number two is the interest rate, which is the ongoing cost of borrowing the money. As I'm sure you can imagine, if I ask a client if they want a high interest rate or a low interest rate, of course, they want a low interest rate. But here's where the dichotomy exists. You do not get both categories at the bottom of the spectrum. When one goes down, one goes up, and vice versa. So in this case, the more you pay in cost, the less you pay in rate. The more you pay in rate, the less you pay in cost. So it's very important for any borrower when they're getting a quote to not just get the rate or the fee, but to get the entire rate and fee quote, which we in the business call pricing. So when it comes to pricing, pricing is constantly on the move. And I want to show you some more information in just a moment here about what is going on right now with pricing. So this image right here that I want to show you is basically the playbook that lenders use across the country to change their pricing. Pricing changes typically each business day, and in some cases can change multiple times in one business day. So this chart you see on here, these red and green images, we call these candlesticks. Candlesticks, in this case, each candlestick summarizes the activity of the market for one business day. The most recent day today is over here. You'll see as I hover over this, over in the black right below, you do see today's date. This goes back, and this chart goes back 3 months. Now, the way to read this chart is that green is good news, and I'm on the consumer side here. So green is good news, red is bad news. The bigger the colored portion of the stick indicates the more the market moved that day in that good news or bad news direction that day as a whole. But here's the kicker, folks. The higher the sticks appear on the chart, the better it is for the quote. The lower, the worse. And you might think, wait, shouldn't low be good because we're looking at rates and we want low rates? This chart measures mortgage-backed securities, which are bonds, and bonds and interest rates go in inverse directions. So for the purpose of this education piece, up is good or high is good, low is bad. So you can see in the last 3 months what's been going on here. We've had a progressive lowering here, which means pricing has gotten worse. We've had a couple of pretty bad days over here, as you can see. And so a good measuring stick here is that good news for the economy is bad news for pricing. So we've had a lot of good news overall. People are going back to work. We are seeing inflation, which is really not a good thing, but inflation is the mortal enemy of pricing. So as inflation rises, we see a general downward trend over here. Now, the only recent uptick we had over here is in connection with the Russian-Ukraine war. I want to be very respectful here. We're not celebrating the war, but in this case, this is bad news for the economy because of the uncertainty of what's going to happen. We saw a couple of big days over here, followed by a pretty bad day yesterday or earlier in the week. The last couple of days have actually gotten a little bit better. Today is actually a surprise because we had a very good jobs report. We thought this would cause the candlestick to come down, but at the same time, the Russians have seized control of a nuclear plant in Ukraine, and the markets are kind of responding, at least in part, to that. Now, if I was to drag out to a larger scale, this is 3 months. What if we go back 6 months? It's harder to see the candlesticks, but you can see the overall trajectory here. We go back 1 year, we can really see just how much we've fallen as of late. And of course, we go back 2 years, you can really see when the pandemic first hit where we were, where we've sort of evolved to now. So the moral of the story is a quote on Monday is useless on Tuesday unless you've locked in your pricing. So more often than not, people have not locked in their pricing. And in this case, the market continues to move on behalf of each of the banks and their pricing. So my friendly advice to you, educate your clients that as the pricing gets worse, you're going to start seeing a lot more companies that are going to be pitching interest rate being low, and they're going to sneak in the higher cost, and or they're going to pitch other programs other than 30-year fixed. That may not be a bad thing in certain cases, but just let's make sure that we're not falling for some of the gimmicks that mortgage companies are going to be having in a rising pricing environment. Thank you for your time today. Hope you have a great day and a great weekend.